I request you to please start with your welcome address, sir.
Thank you. Good afternoon, everyone. I am extremely happy to deliver this welcome address on behalf of ASSOCHAM as well as EGROW Foundation on this Shadow Monetary Policy Committee meeting discussion on monetary policy. Uh, you see, RBI meeting is to be held from 6 August to 8 August, and RBI Monetary Policy Committee role is to tell interest rate, repo rate, inflation outlook, money supply, and macroeconomic indicators. And in this meeting, the guidelines to the RBI that they should, considering the inflation around 5.1% in June because of food inflation, and considering the year will have average inflation rate somewhere at 4.5%. So nowhere above their tolerance limit of 4%. So they are expected to keep the repo rate at 6.5%, and they will not reduce it. Moreover, their consideration is always there. If a Fed Reserve meeting which has been held on 31st July, they have given indications that they will not reduce interest rate uh, by September. They have given full indication that they will reduce interest rate by September, considering their inflation rate, which is around 2.5%, which is near to their tolerance limit of 2%, and uh, cooler inflation, you can say, and uh, unemployment rate is little bit higher. So they have given all indication that they can reduce rate in September quarter. So uh, so RBI can reduce following Federal Reserve reduction of the rate. So RBI can be expected, as per economic survey by Reuters. Actually, 54 economists polled their polled their opinion. 25 out of 54 says that 6.25% rate, repo rate should be by the year end 24-25 financial year, and 23 said out of 54 is rate will not be reduced in this year, and 5 economists says it can go up to 6%. That means 50 paisa reduction, and one economist says 6.35%. So majority is in favor of at least 25 paisa basis point can be reduced by this year end. So I am quite hopeful that this rate will not reduce in this bi-monthly meeting, though this is the 9th meeting where this rate will remain the same. I think I want to listen others, what others says and their views. So I am over. Thank you very much for giving me this opportunity. Thank you, ASSOCHAM, for holding this seminar. So uh, and welcome everyone in this, because my role is to welcome the speakers, Dr. Sujit Bhalla, who is the chairing the session, former Executive Director, India International Monetary Fund, and all other panelists, Dr. Charan Singh, Sri Madhav Nayar, Sri Ranjan Patel, Pental, Sri Surjit Kumar, Miss Upasana Bhardwaj, Sri Indranil Sen Gupta, Sri Abhi Barua, Sri Siddharth Sanyal, Sri Arjun G. Nagarajan, and Sri Basudev Mukherjee. So thank you once again that they joined this seminar and they give their valuable time to this seminar. Thank you very much. Over to Mr. Dr. Charanjit Singh.
So I must thank you, Subhash Agarwal ji, for sharing your thoughts with us. And now Dr. Surjit Bhalla has not been able to join. He is doing an offline presentation at CSCP, so he's on the way. I wanted him to join from wherever he can, but he's very uncomfortable from the car. But he has sent me his views. Here they are. He says, my view is that the RBI may be lulled by fast GDP growth into making the same mistake as in 2019. Redeeming feature is that for the first time, MPC has two dissenters, and that's a historical first. So there is a chance, according to him, that the same interest rate will continue. And I think Mr. Subhash Agarwal has also exactly echoed the same thing. Before I go to the other speakers, I thought I will just share some thoughts with you myself, and then we will go to the next set of speakers. I understand that Rajesh, if I'm correct, Rajan Pental is not joining.
Yes, sir. Along with the Madhav Nair, but Madhav Nair can join any moment, but he has still says he will take some time.
He was asked to join the management committee, so he is
Correct.
right. Yeah, he told me that. And then we have Mr. Sujit Kumar, right? He will join.
Correct. He has already joined, sir.
He's already joined. So
Yes.
maybe we should first give time to Mr. Sujit Kumar to speak. He is the chief economist of NAPFID. Mr. Sujit, would you like to speak and share your thoughts?
Thank you, Dr. Singh. Thank you, ASSOCHAM. Hope I'm audible.
Yes, you are.
Thank you. I think broader contours are what Dr. Agarwal has already laid out in terms of growth, where it was previous fiscal and where we are seeing in the current fiscal. So there is indeed some comfort from monetary policy perspective that growth is not as weaker as it should merit some policy accommodation from the monetary policy side. However, Q1 data that we have, it shows that the momentum is sequentially a bit coming down. Inflation, on the other hand, the sticky factor is whether there will be persistence of vegetable prices volatility, which will kind of give some uncertainty on whether the inflation will conform to the 4%, 4.5% which RBI is looking at from the medium term perspective. But the good thing is that from fiscal side, the incremental stimulus, which is about fiscal deficit, that is coming down. So we are not having a situation where monetary policy and fiscal policy both have to kind of address bringing the price impulses down. So this gives us some comfort for monetary policy to be a bit softer, be a bit more accommodative to growth concerns. Thankfully, external sector is quite comfortable. So current account is not something policymaker is worried about today in terms of financing it. So that gives some leverage in terms of whether policy can indeed turn accommodative going forward. For now, what we expect is that while the RBI may continue with its pause policy, but yeah, the consideration of having easier rates in the second half is indeed pretty much evident. So we would hope that RBI indeed turns dovish, specifically after October policy. That's what we are having a view on. Thank you.
So let me then share my thoughts, and then I will go to my colleagues. First of all, we have just had a budget, and I think the budget has been very, very encouraging. The budget has shown us the growth trajectory to be very, very strong. Just before that, we had the economic survey, and the economic survey had clearly shown that sort of the foundation has been made pure steel, and the Indian economy is obviously expected to grow from strength to strength. The union budget assumes a growth of 10.5% nominal, of course, which is also very robust. And knowing that our inflation will be around 5%. So that was little worrisome to me that where is our growth actually heading for? So but I'm expecting, like we have averaged nearly 8% growth last year, and which was much more than what was initially provisioned and projected. So I'm expecting the growth this year will certainly be also more than 7% which is being thought of in real terms. So growth trajectory is very good. Going by the high frequency indicators again, some of which has been mentioned now by Mr. Sujit and some mentioned by Mr. Subhash Agrawal, that there is a chance of exports also doing very well because the global economy seems to be on the recovery path. So exports could be doing well. Our growth projections are very good. And therefore, and the budget is employment oriented. So that means there is chance of demand being created. And the budget is not inflationary at all in any way. So there's every chance that we'll be able to contain inflation within the band that we have. The implication for us, for the monetary policy then would be that if market borrowings program is again under control, capital expenditure is high, revenue deficit is again under control, gross fiscal deficit has not only followed the glide path, has improved on the glide path from 5.1 to 4.9. I think that's very, very impressive track record. The high frequency indicators again indicate that the industry is doing well. The agriculture sector growth pattern is also doing very well. Therefore, growth is assured. And export was one dampness, but that is also being taken care of. The type of incentives which have been given in the budget, of course, first on employment, and then the most important thing is infrastructure, which has intergenerational multiplier effect, point which even Mr. Agarwal made, shows that growth is not only going to be high this year, but is going to be on a sustainable basis for the next few years. The government has taken care of agriculture, industry, MSMEs, and therefore the growth trajectory is going to be very, very good. The main issue, and we have analyzed these things in the past for many shadow monetary policies, but the main issue that remains is how is the Fed going to behave, and on the basis of what the Fed is going to do, it seems we will be taking our initiatives. Given by what Chairman Powell mentioned in his initial remarks as well as the press conference yesterday, he was very clear repeatedly that he is playing to his own economy. He thinks they are in a very good condition. Unemployment rate is very, very low, so people are fully employed. And inflation is, of course, not 2%, but it has come back tremendously, significantly from the peak of around 9% to around 2.5 odd percent. But listening to Chairman Powell, one could easily make out, while he keeps saying that they are ready and they will take any necessary action when required, it's almost emerging that anything which is a slight digression from the data that they want in, be it growth, be it employment, be it inflation, if there's even a slight digression, they are not going to go in for the rate correction. So therefore, September, to my mind, is ruled out because something or the other will continue to happen. And I don't think they'll be able to meet their, because it's not only inflation now. He's clearly saying there's a dual mandate. I have to take care of employment, I have to take care of inflation. And in employment, he clearly says just not the unemployment rate. I'm looking at the hiring pattern. I'm looking at the attrition. I'm looking at the complete process of people joining and all that. So therefore, I think, quote unquote, looking for excuses for not lowering the interest rate. So to my mind, America will not lower the interest rates at least till January. And that means the election cycle will be over. Then the issue is, should India, RBI, decouple from the interest rate that the USA is offering? I think that is the crucial debate that is going to take place at the MPC this time. It's certainly not going to be the growth pattern and inflation. That's not going to be the debate according to me. The debate is going to be, because all the price indicators, CPI or WPI, are not at all wavering as much that it should justify such a high interest rate. So the main debate, according to me, in the MPC will be on, should we decouple or should we not decouple? On that, my own personal view is RBI has demonstrated repeatedly, for various reasons, which some have been articulated and some I think have not been articulated, that they will not, or they prefer not to decouple from the US interest rate. So if that is going to be the story, that America seems reluctant to change its interest rate until at least January, I have a feeling that the Reserve Bank of India will also not decouple and lower the interest rate. My personal view and my personal understanding is that yes, the interest rates are high and the growth is high. So one can say, if interest rates are not harming growth, what is the logic of insisting persistently of asking the RBI to lower the interest rate? My own understanding then is that though we are recording 7% growth rate or 8.1 as we did in the last year, while we are projecting and thinking of doing 7% growth rate, I think that's not our potential best. Our potential best is around 9 to 10%. And if we lower the interest rate, we will be able to gain that potential best. That is where I think the argument should be, that while our inflation was never as high as that of America, in the first place, we should not have scaled up the interest rate so rapidly. But if we had to maintain a certain difference between the US and India, and we did it, I think now a time has come to understand that the US is entering a political cycle, and for them to lower the guards and lower the interest rate at this juncture may not be the right policy signal. But in our country, our election cycle is over, and I think we should be able to start with a 25 basis cut. So my recommendation would be, it's time to decouple. America is playing strongly to its own gallery, which is within the country, the constituency. They are very clearly articulating that they are looking at employment and inflation. Inflation is still not in their comfort zone of 2%. That is all understood. But I think if they are playing so strongly to their citizen and their growth, and they think they are passing through the best phase, India should now start thinking in terms of decoupling and then start looking at the economy within the country itself, and worrying not too much on the parity between the US and the India interest rate, which I mean to say that trying to maintain a certain gap, I think one should be able to come out of it. My recommendation then there is high time now. For a long time, we have, some economists, some of us have been saying, and there is rumbling happening in the MPC. If you look through the minutes, I think this is the time when we should go for a 25 basis rate cut. That would be my recommendation. Okay. Let me now move on to our next set of speakers. I think Madhav Nair has not come. I don't see him. If Madhav Nair, he's representing the industry, and EGROW attempts to bring the industry and academicians and practitioners together. And Madhav Nair, if he joins, we'll give him time whenever he joins. Let me then go over to Indraneel. Indraneel will share some of his thoughts. Indraneel?
Yeah. So my base case is that the RBI cuts in October, and maybe sounds relatively more dovish than they have been in September. Again, because I think that there seems to be a mental block at the RBI against decoupling with the Fed, and so maybe the RBI will want to see whether they are, the Fed is actually going to cut or not. Now, when I see the landscape, I think that the case for cutting rates, in my mind, has been there for quite a while. And I was actually calling for rate cuts much earlier. So, if you look at growth, forget GDP numbers, the real GVA growth, which is what the economy is all about, is clearly slowing, and is set to slow further in this year. Inflation is well within the RBI's boundaries as a headline. In terms of core, inflation is way below the 4% mark. The real rate of interest, any which way you look at it, is very high. On the overall, it's around 1.4% now. If you look at the RBI's own forecast, it's 200 basis points. If you take it with core, it is almost 300 basis points plus. So I do agree with the members of the Monetary Policy Committee that such high rates cannot but bode a problem as far as the real economy is concerned. But that argument does not seem to be washing with the RBI's ultra careful stance, although there is now sufficient FX reserves. I have always argued that higher rates in India actually hurt the rupee rather than the other way around, because in India, the foreign institutional investors in equities have an investment of $650-700 billion, which is almost 15 to 20 times that of debt. And obviously, equity investors chase growth. So we saw this, in July 2013, that the RBI raised rates, everyone left, and the rupee went from 59 to 67. So I think that there is a theoretical case for cutting rates, has been there for a while, but that has to be counterbalanced with the RBI search for safety and surety. Now that is difficult to get in this environment where the Fed's own record of forecasting growth, forecasting inflation is looking very, very dicey. I mean, when inflation went up, they said we'll cut thrice, then inflation came down, then now they're saying we'll cut once. You are almost doubling your growth projection sitting in the September of 2023. So somewhere down the line, the Fed itself, unlike I think any time in recent history, has become a source of inflation uncertainty rather than a source of assurance. So while I think that in terms of what should be done, there should be a rate cut for sure, but we deal with what will happen, and then I think there will be probably a pause. So I'll stop here.
Thank you, Indraneel. So you are anticipating a pause, though you're recommending a rate cut. Is that the
Yes,
right
of course. Yeah,
interpretation? Thank you so much. So let me move on, and I don't see Madhav Nair joined. So then I'll go with the EGROW side. Let me then invite Arjun. Arjun Nagaraj.
Can you hear me, Mr.
Yes,
Singh?
we can hear you. And
Perfect,
after
perfect.
Arjun, then we'll come to Siddharth to have the last word from our side. Arjun?
Yeah, perfect. Thanks a lot, Mr. Singh. Thanks a lot for having me here. Thanks a lot, ASSOCHAM as well. So I'll just break this down into three parts. Firstly, on the Fed, that what we saw last night. Second is the RBI, and thirdly, the budget. Now, the entire narrative that we heard last night was a lot of conviction that the Fed will start cutting rates by September. Markets seem to be very tuned to expect a September rate cut for at least 2-3 weeks now, expecting, especially last night, a fair bit of an expectation. Now, Powell's commentary appeared increasingly open. However, he sort of balanced it with a lot of ifs and buts. Now, you're going to see two more CPI prints. You're going to see two more non-farm payroll numbers. You're going to see two more retail sales numbers and one more PMI number in the US for the month of August. So there's a lot of data points ahead of the September policy. I think it's too early to be extremely sure that the September rate cut from the Fed will happen. Now, our base case continues to be that there will be a Fed rate cut only from start of 2025. Worst case scenario, probably a December of 2024. We don't really see a September happening, largely on account of the fact that though there are some weaknesses in certain pockets of the economy, broadly growth remains fairly strong. And I think the June quarter GDP numbers in the US came in at 2.8% quarter on quarter annualized, way above what the markets were expecting at 2%. So there's still a lot of inherent strength. And the last thing the Fed wants at this point in time is to see a rebound of inflation, especially when the political scene in the US also is a little tricky. If there is going to be a Trump presidency, the probability of inflation going up just on account of tariffs, I'm not even looking at increased government spending, that itself is a fair bit. So political uncertainty, there's a fair bit of that, and growth remains fairly strong in the US. So from a base case point of view, we're still expecting only around start of 2025 rate cuts from the Fed. Now, that I think is important for the RBI. I think we continue to remain hawkish, and we think that the RBI will continue to remain hawkish, though there is some increasing dissent within. Growth in India also remains fairly strong. Core inflation is at decadal lows, but headline is still sort of holding up. So, given this Fed base case of early 2025, we are expecting for most of FY25, we are not really seeing any rate cuts, but there's a moderate probability we're assigning to a post 2025 budget somewhere in the RBI's February 2025 monetary policy, maybe a start to the rate cuts, provided the Fed has already started delivering its easing cycle by possibly end of 2024 or early 2025 or so. That was on the Fed. On the budget, I think we're fairly happy to see two very strong narratives in the budget. One, aggressive fiscal consolidation, and second, on the capex front, continued conviction and continued intent. If you look at the total capex number, which includes the PSUs, you're seeing a pickup there. So from the interim to the final budget, two things changed. One on the political equation, which is a coalition government, and second, the excess RBI dividend. Almost all of the excess RBI dividend, apart from going towards consolidating the fiscal, has seen a lot go into states, in the form of state transfers, capex to states, and a lot of state spends. So that focus seems to be there. I think we're fairly happy from a budget point of view, at least numbers point of view. It's not too different from the interim, but only one concern in my mind is there seems to be a lot of focus on consolidation, lot of focus to try and attract investors, bring yields down. There seems to be an excessive focus, probably, I hope not, but at this point in time on ratings, bringing ratings down. So my only concern is in the medium term, would this excessive concern or rather excessive focus of the government to bring yields lower and bring ratings better for India, is that going to come at the cost of medium-term growth at a very crucial point in time that India is in, where you really need a fair bit of government support if the private capex engine doesn't really pick up steam? I think I'll stop there. That's broadly what I wanted to
A
say.
quick question. You know, the government has announced a 50-year loan for some states. Now, what do you think of a 50-year loan? How is it going to impact, or where do you see it getting placed? Means, will it put a stress or will it impact the yield curve? The 50-year loan being done by the government, and I haven't seen, but are you aware what the volumes are going to be of a 50-year loan?
I really am not aware of the volumes, but from a state's point of view, you're seeing increasing expenditure pressure, in the sense that every single state wants to go a little more populist, is what you're hearing. So from a ratings point of view, I think the last commentary we heard from S&P was, we want a combined fiscal deficit center plus state at around 7%. So even if you assume the center is very aggressive and brings it to 4, which means you need states at 3. We're already seeing states only at 3.1. I think that is the estimate for FY24. FY25 is likely to be much higher. So I would only think that this will put more pressure on states. I'm a little unaware of what the volumes will be like on the loans front.
But I thought the rating agencies were pretty happy with the consolidation path we were following.
Yes.
Rather,
yes.
what I read was that they feel if India continues so aggressively on its consolidation path, which I think is solid, you could be right, it's RBI profit 2.1 or whatever be the tax collection. But the fact is the fiscal deficit has been revised downwards between interim and the final budget, right?
That was a real surprise.
That's a real surprise. So I think.
And if you actually compare FY24 budgeted numbers and FY25 budgeted numbers, the fiscal deficit has actually come down by 100 basis points. 5.9 has come down to 4.9.
4.9. So
I think yes, all kudos to the government on that. But my only concern is, I think just before the election numbers came out, the S&P made out a statement saying that if India's ratings has to improve by 1 notch, we would want the combined fiscal deficit at 7%, is a commentary that they made. Even if the government does go in that direction, they will have to sort of overcompensate for the states not consolidating. And I feel at this point in time, when even the economic survey and the budget commentary from the Honorable Finance Minister, both of them sort of sounded very similar, saying that, see, we've done as much as we can. Now the focus is actually on you guys, on the corporate sector, on corporate capex. So we are at a time where the government is saying, hey, we've done our little bit that we can. Now it's up to you guys. Now, if that private capex doesn't pick up to the extent that they might want, you would still need a fair bit of government support at a point in time that we are actually consolidating on the fiscal front. Then we are increasingly dependent on one-offs, like probably from an RBI or a disinvestment, to see to it that push is there for the economy. That is the only concern. In the sense, are we really going too aggressive on the consolidation front, expecting ratings? What if the ratings narrative doesn't play out?
Thank you. Siddharth, over to you. You have the last word now.
Sure. Thank you very much once again. Always great to be on this particular platform. In terms of rates, we don't expect any movement in rates in this particular policy meeting, and also for a few more policy meetings. So in a way, my call on the rates front is something very similar to what Arjun just mentioned a few minutes back. So I don't really pencil in any cut in this particular calendar year. Maybe sometime in the next calendar year, there might be a cut from RBI that we do hope and expect. If I see in terms of the inflation trajectory of late, we are seeing that inflation is still pretty benign. The headline inflation has inched up a bit, but if we do a bit of an adjustment, looking at the core has bottomed at this moment. At this moment, it's a multi-year low. It might go up a little higher in the coming months, but still well below 4% is more likely the scenario in the next several months. I don't really see too much of momentum on the inflation front at this moment. But given the communication on the part of RBI that we have witnessed of late, that they wanted to maintain something like a roughly, they mentioned 1.4 to 1.9 kind of a spread in terms of the nominal repo rate over inflation. So if I think about that and going by my inflation forecast for this particular financial year, which is marginally higher than what the RBI had in the previous as per the latest release, our number is something in the zone of 470, 480 on an average for this particular financial year. So if that is the case, with a 150 basis point markup on that, going by RBI's own communication, whatever they have said at this moment, looks like they are not really too keen to go for a rate action at this moment. Having said that, there are a few things which are changing in terms of the budget. Very clearly, there is not much of an inflationary pressure coming from the budget. Number one, that's pretty clear. Growth impetus, little bit not very strong, but some bit of growth impetus, but definitely not an inflationary budget as in case of some of the other budgets earlier we used to discuss. Fiscal maths broadly looking credible, so definitely a much more fiscal regime that gives monetary policy a little more room. Also, as all my previous speakers have mentioned, that what is happening in terms of the global trajectory, I think yesterday's commentary from Governor Powell was pretty important. If I see in terms of how the swap market reacted, so before this particular announcement, yesterday's announcement, they were assigning, swap market was assigning something like 60-65% probability of a September cut, which has now reached close to 90%. And at this moment, again, 60-65% probability is assigned to overall 3 cuts during the calendar year itself. So possibly the market's interpretation at this moment is that the Fed is creating ground for rate action, if any, in the coming months. So in September, followed by more rate cuts from the Fed, will not be very surprising. Also, as I said, budget is definitely not inflationary. Now the question is, if RBI is not very keen to cut the repo rate right now, whether they can do something else. My sense is that one very clear area where they can think a little more is possibly in terms of the quantum of liquidity they provide to the market. So if I see in terms of the primary source of liquidity to the market, which is reserve money or best money or high-powered money, whichever way we call it, the growth in reserve money in the last 2.5 years had been particularly weak or particularly soft. It moves somewhere in the zone of 6 to 8% more often than not. Now, what is the usual trajectory in the past? If you see long-term trend on that particular parameter, the numbers are very rarely below 12-13%, if not in the zone of 15% plus. In the past, if we see last 10, 15, 20, 30 years, more often than not, the number is in that zone. So I was looking at the growth numbers on reserve money, which is, again, just for people who possibly do not track this particular parameter that closely. You can, loosely speaking, this is the primary source of liquidity to the market. And today, there is a lot of discussion about availability of liquidity, banking system liquidity, fight for deposits in the banking system, whichever way you call it. Very clearly, there is room for enhancing the supply of liquidity from RBI a little more. Now, just coming back to that particular point of reserve money growth, if I look at the history of reserve money growth in the last 10, 15, 20 years, I can see just one particular phase during FY12 and FY13 when reserve money growth averaged somewhere around 5% at that particular point in time. Today it's about 6 to 8% in most of the months. But now if I compare that particular period with today's numbers, we are talking about in 2012 and 2013, India was a part of fragile five economies. It was a time for taper tantrum. India's CPI inflation used to average around 8.5%. India's current account deficit was moving closer to 5% compared to today's sub 1%. Fiscal deficit was much higher. So all parameters, all health parameters were way too different, way too lax for the RBI at that particular point in time to offer more liquidity to the market, and that's why they possibly kept it under tight leash. Compared to that, there is absolutely no comparison. I mean, very difficult to think a situation where for the third consecutive year we remain so very conservative on the liquidity liquidity front. So basically, my sense is that when the RBI is very conservative or very hesitant to start cutting the rate cycle at this moment, one important initiative, one important move from their side can be to start stepping up on the liquidity front. That means if I see in terms of the reserve money growth rate from the current 6-8% zone, the latest numbers are slightly better or north of 8%. I do expect that number to start moving higher in the double digit and in the teens at some point of time. And it's not very difficult in the sense, given that now there is the fiscal parameters are good. Now the bond market bond index inclusion has taken place. Flows seem to be decent. What possibly the RBI would have to do that whenever they are mopping up some dollars from the market and offering some rupee liquidity to the market, they should just be slightly less aggressive in terms of mopping it up with their WMO sales. So that will lead to a situation where the rupee liquidity availability with the market is relatively better. RBI will keep on mopping up more and more foreign exchange reserve, which in today's era should only be seen as a unidirectional positive at this moment, and that should provide the market. I mean, even the banking sector, liquidity will start possibly improving a bit, and the excessive fight for deposits among banks, the uptick in deposit rates that we have witnessed in recent months, possibly that will come to that will provide some bit of relief, cushion, comfort, whatever you call it. That particular factor is also very interesting. That now we are at in the month of August. The last RBI hike had taken place something around 18 months back, but we are seeing still large banks in the Indian context are still being compelled to hike deposit rates, etc. That should also start. That should also induce RBI to think a little more closely on this particular topic, and my expectation is that they will start stepping up a little more on this particular aspect. The last point I would like to mention is about the stance. My sense is that moving on to a neutral stance is long overdue. Again, if we have seen the last hike something around 18 months back, the next move, as and when it takes place, is likely to be a cut. Also on the liquidity front, for the last several months, they had been actually withdrawing liquidity, but now for the last couple of quarters or a little more than that, it's a time when they're moving actually sideways, or there are two-way movements. So in this kind of a situation, if it's possibly apt to call the overall monetary policy stance to be neutral, without thinking too much about how the market will be interpreting it, etc., etc. So these are the few suggestions or overall expectation from my side. I do not really expect the RBI to quickly deliver any kind of rate cut anytime soon. I do hope and expect that they start providing a larger quantum of liquidity to the market, and the reserve money growth starts going higher from here. And I'll be very happy if I get to see the stance getting changed to a neutral stance.
Thank you, Siddharth. What you are trying to say, and if I understand you correctly, is that you are not even recommending a rate cut right now.
I'm not. On the rates front, the way I'm seeing that at 6.5%, it's kind of aligned to the long-term average, and I do would like to understand more about the RBI's guidance of 1.4 to 1.9 or 1.5 to 2, whichever way you see it. How exactly they are, what they want to mean by that, and stuff like that. So I'm not really recommending also a cut at this moment, but I think the providing a bit more some bit of easing through the liquidity front is a lot more nuanced also. That actually is quite impactful also for the overall banking system, and that does allow them to offer some bit of easing to the market without creating a headline just at this moment, and they can actually control it, still provide some bit of effect of some bit of easing to the market.
Sir, do you have a view on the 50-year loan? How will it impact the market and the yield curve?
You mean the GOI bonds?
Yeah.
I think one particular change has taken place over the course of the last 5-10 years is that, so earlier, 20 years back, 15 years back, the biggest contributor to the bond market or the demand used to come largely from banks. And banks means their liability side used to be that of deposits, which used to be of, say, a duration of 5 years, 3 years, 5 years, 7 years. So Indian government issued bonds used to be of a tenure of 10 year, 15 year was more popular. But now one particular factor has become much more important in the overall scheme of things. Insurance companies, PF, Provident Fund, they have become structurally a lot more important. Now, if you think about their liability base has a commitment for the next 30 years, 40 years, etc. So very long dated commitments on the liability side they have. So there is a much better ground for Indian government to issue long dated bonds these days, and those bonds, whenever they have issued, have done fairly well.
So, Indranil, you have worked on these issues also. Would you have a view on this? And also, I wanted to check with you in Paul's Fed chief's talk yesterday. He did speak that we are almost there where we were pre-COVID. I think in India also, we have been saying that we have already attained that we have covered it and we are over it. Any view that you would have on these two issues?
Well, I think the Fed is also, in an equally wait and watch mode as the rest of us. They, at least the chairman wants to bring rates down. Not so sure about the rest of the MPC. So I think they will go number by number to see what happens. And, this uncertainty to some extent will continue. But there is at least one more inflation number. If that is soft, then I think at least one can make a working assumption that the Fed will cut, if not in September, then maybe the next time. About the RBI, I think the reserve money part is largely explained by the banning of rupees 2,000 notes, which is about 3.5 lakh crore. If you adjust for that, reserve money is about 12%, but credit growth has been much higher, and that I think is the reason why, to some extent we are seeing tightness in the markets at times. Also, that the RBI, has to at some stage try to infuse liquidity, whether it is through FX or whether it is through bonds. Now, of course, there are measures being taken to buy as much as FX, as possible, but get the government to buy, I presume, to defend the the tight stance of monetary policy. But we could just go to neutral. What is the point of saying we are keeping a tight monetary policy stance? So therefore, instead of us buying government securities through OMO, the government is doing a buyback. I mean, that's just semantics. So I think that for sure, as Siddharth said, that the RBI should infuse liquidity. That is number one. I also think that the time is certainly come for it to cut rates, especially given that the burden of the high repo rates are being borne by the vulnerable sectors because of the EBLR. The lending rates are linked to the RBI policy rate. So we are coming to a curious situation where the compulsions of the FX market are going and hurting the small borrower, the small business housing loan borrower, and so on, who are ending up paying, I think, about 70 basis points more than the average borrower. This linking was done to protect the small borrower. Now it is ended up taxing the small borrower. So I think that there could be some other measures as well the RBI could think of. For example, it could exempt loans to small borrowers from CRR or something like that. But going on taking chances with with such a high real rate at a time when real GVA growth is slowing down quite sharply does not bode well for the future.
Okay. Arjun, do you want to add something? You have heard both the speakers from the market. Arjun, would you like to add something?
Yes, Mr. Singh. Nothing really much. I sort of agree with both of them on the liquidity part. And if our flows do come in, I think you will see an increase in liquidity. The RBI starts mopping up more forex reserves as well. So I think to a large extent, how the flows are going to be into the next 8-9 months, I think will be also fairly critical.
Thank you. Sujit, you want to add something now?
Actually, fairly agree with the participants' view on the expectations of from RBI. Just one single point that for us, getting cost of capital down on a sustained basis from long-term perspective is equally important. While government is doing its bit in terms of adhering to fiscal path that they had guided for, I think still the borrowing costs for corporates have significantly not moderated. Though GSEC yields have come down by very sharp margin, corporate borrowing still there. The expectation of monetary policy is playing an anchor role. So sooner we do it, the better it is going to get in terms of supporting growth. So that's what I would like to end with.
So Sujit, would you recommend a rate cut now? I am recommending. Indranil is recommending. Siddharth is not recommending. Arjun is not recommending. Are you recommending?
Perhaps not in August, but then obviously in second half I'm all for it.
Second, you mean sometimes in October
onwards, yes.
Yeah. Arjun, is my interpretation correct that you are not also recommending now?
Yes, Mr. Singh, I'm not looking at any rate cuts in FY25.
Yeah, you went too far. Means I was
Yes.
thinking that January Fed will do it and we'll follow it soon. But you and Siddharth both are talking of FY next year, so that's okay. All right. I think we have a fair bit of idea now. Where
I
we are also,
have one rate cut. I have one rate cut in February.
Yeah.
But
you are talking in February, right?
that's
So
that's
during
that's
that time.
that's correct.
And
That's
Arjun, you are thinking in April onwards, not during the current financial year.
Yes, I think most likely all through FY25 there will be nothing unless something really changes from the Fed front. There's a moderate probability, a very low probability I'm assigning to a post FY25 2025 budget, a rate cut from the RBI. is provided by then the Fed has already started.
I'm so scared, because such a high rate which we are carrying now for next 7-8 months, I don't know how and what it'll impact. Though we've run out of time, there's one quick question I wanted to check if any one of you wants to reflect the deposit story which emerged of late when Siddharth brought it. We all know that there is a very big problem on deposits. We all know the reason. Funds are getting diverted to physical assets and the mutual funds, and that credit is taking off in a big way and deposits are not matching, and therefore the balance sheet of the banks is really under stress. Anyone, any thought on this? Any one of you?
Well, I would say that, when people buy mutual funds, they just transfer money from their fixed deposit to the current account of the mutual fund. So I don't think that the bank deposits get impacted whether anyone buys a mutual fund or a physical asset, because it's just money going through the system. You only have to have money going to small savings or money going outside the economy. Now that said, I think the crux of the problem is also that, like we said, that deposit growth is largely driven by reserve money, and reserve money growth is been relatively muted. It's maybe one good thing was that at least because of the rupees 2000 banning, there was some liquidity which went back to the banking system. But I suspect that if we look at core reserve money, that is ex repos, which is what drives deposit rates, that may not be that high. So I think it is the RBI which has to provide liquidity to solve the problem of deposits.
Okay. All right. Me and Siddharth both have relationship with the banking system. So good Siddharth brought out something which we face every day. But Arjun, do you have a view on it? Or Sujit, do you have a view on this?
Now, I sort of agree with Mr. Indranil Sen. I was talking about how it is the RBI's call on what the reserve money number should be. Why that has been the way it is, I don't have any guesses on why it has been so.
Sujit, how about you?
While broadly concur with Indranil's view that while mutual funds do have a current account and that system remains as it is, but what I have in fact found out is that as chains of intermediation rises, the lag with which deposits get to the banking system also goes up, and which creates some interim issues between CD mobilization. That's what we are playing out. So banks are raising funds via market, raising through bonds, fund their credit expansion. So there is a choice between paying higher to retail depositors or paying higher to the bond subscriber. I think they are taking the latter call. So that is one of the also factors. Now, as far as savers, they do have a choice today. They could fund the same corporate by subscribing to their bond or to their resource raising in the primary market, rather than it going via banks credit. So the dynamics are different today. So I think we also need to look at differently rather than just the conventional view that credit translates into deposits and that way. So that's where we are at the moment. Hopefully it sorts out.
Thank you. Rajesh, I'm sorry.
I just wanted to highlight one thing that, I mentioned earlier also, that if I see the last RBI hike took place some 18 months back. Even now, there are banks who are forced to hike deposit rates even at this moment. Yep. So possibly the answer lies more and more in liquidity and more in primary liquidity, and that's in other words reserve money. That's possibly what needs to be stepped up on some kind of an urgent basis. Otherwise, Dr. Singh, you also mentioned that that credit is growing at a pretty high rate. Now, that's the general narrative also, that credit is growing at a pretty high rate. But the fact is that if we look at that particular rate, that rate is around 15-16%. That's a decent rate, but not an abnormally high rate.
Yep.
Because credit growth in the past, we have seen that 15-16% is just about average long-term credit growth rate. In the past, there had been instances for it to sustain in the 18-20% range for a fairly long period of time. And there are instances of maybe not so healthy instances, but of high 20% and even in mid 30% kind of credit growth instances also we have seen. I'm not talking about that. All I'm trying to say that a 15-16% credit growth that we are seeing at this moment is just about average long-term growth rate. On that, possibly we will see a little bit of softening in the credit growth rate numbers going ahead, simply because that the capex is not really, private capex is just not really happening, and there is a constant pushback on the unsecured loan part, retail lending part, etc., etc. So from the 16% plus kind of a rate, maybe eventually during the course of the year we may see a bit of, say, 2-3 percentage point kind of softening in the credit growth rate by the end of the year. But the deposit growth rate has to be should match at least that much. The current 11-12% is way too soft compared to the long-term trend, and that's why providing more liquidity, in my view, is a clear urgency.
Siddharth, I totally agree with you. Means I would say, rather pray that the credit growth rate should not slow down, because the balance sheets of the banks, that's where all their income is coming from, and then the dividends come from. And therefore, I think the need is somehow, be it the lagged effect as Sujit is mentioning, or whatever, but I think whatever said and done, it has to be that the deposit growth goes up. Now, how are we going to ensure that? I'm not really sure, but I think that's where the solution lies. And I agree with you. I'm really thankful to you have brought the reserve money story. Many of us have almost forgotten the reserve money, and we have always been working only on rate. So good you brought in that point, and I hope we use that, as Indranil mentioned. I liked it. I hope we use that route and ensure that deposits are healthy. Rajesh, I have taken 9 minutes extra than what you had planned. Thank you very much, but I'm sure you noticed how intense and beautiful the discussion was, how rich the discussion was. Over to you.
Thank you so much, sir. Now I request Mr. Vasudev Mukherjee to conclude the session and give the formal vote of thanks.
Thank you, Rajesh. This has really been an interesting session, and I agree with Dr. Charan Singh about that this has been a very rich discussion and a lot of takeaways. As always, we'll be consolidating everything together, and we'll be submitting our recommendations to the Reserve Bank on the monetary policy, and we look forward to having you once again in another 2 months. So thank you once again.
Thank you very much.
Thank you so much, sir.
Thank you.
So now, sir, we are now closing the session.